All right, so after the break, we're back to look at two particular topics. Internal controls, which is our policies and procedures to make sure people do what we want them to do within firms, and then audit sampling. And audit sampling comes about, let me just change my pen here. So we know that knowing about internal controls feeds into our audit risk model. And hopefully, after our video interviews, most people know that this is what the audit risk model looks like. And we've learned about how to assess inherent risk. Today we're going to look at what goes into control risk. And then this feeds into our audit strategy, whether we're going to have substantive tests or tests of controls. And whatever our audit strategy, we need to be able to collect evidence to allow us to generate what at the very end? What's the end product? Our opinion, yeah. Now, the problem with collecting evidence, or the issue, is that we can't test every single transaction. That's just not going to be feasible in terms of time, in terms of cost. So, what we need to do is we're going to collect a sample, a subset, and then we're going to make some general opinions based on that sample about everyone within the population. All right? So if this is the entire population of transactions, we're only going to test some of those transactions, and then we're going to make our opinion based on that small segment. All right? But we're going to make an opinion about the entire set of information, even though we've only looked at some of it. And that's what sampling is all about. So, Chapter 8, in terms of internal controls, we've got a fair number of objectives to get through this week. It is a bit of a heavy week for the first week back for the break. But why do management need internal controls? All right, we're going to look at IT, the 5 components of internal controls, and you're going to see a diagram with a little pyramid that you're going to learn. Shh. That's Harrison. I'm pretty sure I saw you. Or was it Dan? Okay, all right. As long as everybody's quiet, and I don't need to throw anybody out, that's fine. Shh. All the international students that are listening to the lecture video are now probably wondering, who are Harrison and Dan? I should add photos to the lecture video so that everybody knows who you are. All right, so we're going to look at strengths of internal controls and deficiencies, and then we're going to look at designing and testing internal controls. All right, so why do management need good internal controls? So what's management's job? What do management have to do? What is their role? Their role is to do what? Guide the firm to achieve its objectives, okay? And management's job really comes down to decision making. All right? Now, how often will management make decisions in a day? Once a day, 5 times a day, 10 times a day, 50 times a day? That is the bread and butter of what they do, okay? Now, when you're making a decision, what do you need to use to make a decision? Their brains, yes. So certainly yes, brain is one. That's our first one. What else do they use? They could use mathematical skills. But if they're going to use mathematical skills, what are they going to base that or use in that? To do those skills, they need information. All right? So their brains plus information is what they use for decision making. So the key for us as the auditor is making sure that this information is as accurate as possible, because management make decisions not just at the end of the year on audited information, they make decisions every single day on unaudited information. All right? So the key there is that they make their decisions using unaudited information. So that means it is in management's best interest to have good policies and procedures, good systems to make sure that the information they collect about all of their transactions meets the assertions, is accurate, reliable, all of our sales really did happen, we've recorded it at the correct amount, our inventory movements are correct. So one of the reasons why management want to have good internal controls is so that when they produce external reports, they're reliable. But the key one, from their perspective, is that one right here, effectiveness of their operations. They want to make sure that they're making the right decisions using the right information. If you use the wrong information to make a decision, it might be suboptimal or even the exact opposite of what you thought you might do. Now, the third reason why companies have internal controls is to make sure that they comply with applicable laws and regulations. So that could be everything from GST, it could be about superannuation, it could be about some sort of environmental protection agency issue. Whatever it might be, the government requires people to collect information on a range of different things, but we need to make sure that we comply with that information gathering as well. So management's responsibility is to maintain and design the internal controls. All right? So their job is to design those policies and procedures and, if necessary, update them if conditions change. Now, with internal controls should provide reasonable but not absolute assurance. All right? You cannot design a control to prevent absolutely everything from happening within most organizations, because later on we're going to talk about cost versus benefit about internal controls. So what are the limitations around controls? As I mentioned before, cost versus benefit. Certainly, if you wanted to stamp out theft from Target or Woolworths or any retail organisation, then when people leave, you could put them through the same sort of X-ray scanner that you go through at the airport. Right? The airport is pretty high risk, so you go and stand and you put your arms out in that big X position, and the machine X-ray scans you. But if I had to do that every time I wanted to pop into Woolies just to buy some lunch or some chewing gum or some chocolates, that would be a real pain in the ass. Right? And so they have to think about, well, what's going to entice customers in, but what's going to be also cost effective. So there's a balance between how much control do I exert versus the cost of it. Now, if I wanted to make sure that in the final exam nobody was cheating, I would hire one exam supervisor for every single student, and I would make them sit there and watch you. Now, that's not very cost effective, and I think if I was a student that would put me off, to have somebody just sitting there staring at me. But that would be 100% assurance there. So you have to weigh up within the organisation what is the risk of letting something happen, a mistake happen, versus what is the cost of control. And certainly in retail organisations, they have something that they call shrinkage, which is their acceptable loss for theft. And so they're not worried if you steal a can of tuna or a chewing gum. They have about a 5% allowance for loss. But it's going to be hard to try and steal, an entire turkey. And if you've been into some supermarkets recently, you may notice that at some Coles and Woolworths, they are actually putting RFID tags on meat because people are stealing expensive steaks. Probably not the mince, but the $30 or $40 a kilo Scotch fillet or eye fillet or pork belly, they're actually putting little RFID tags on them so that if you don't get it deactivated at the cash register, when you walk out the store, it'll go beep, 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 beep. Now, another limitation is that there may not be controls for unusual transactions. Something that never happens that is going to occur, I don't know, there's no policy and procedure in that, so that's where you're likely to have some mistakes as a result. The other thing about controls is human error. Humans who have to execute controls of searching things or viewing things or checking things, we get tired, we get sick, you get grumpy, you get, at 3 o'clock you might get hungry and angry, you get hangry. All right. So humans tend to have the capacity to make mistakes, which we want to try and prevent, but we can't always get away with or avoid entirely. There can be people working together to get around internal controls. So you may have lots of internal controls in place, but if you have 3 or 4 people working together to get around those controls, then certainly that's when we have lots of intentional fraud. All right. People may have certain powers that they may abuse, which is again another point of fraud. And then procedures may become inadequate. This happens quite often in companies that grow quite quickly. They start small, they have procedures that suit a small business, but as they get larger and larger, their procedures may not change or may not adjust to take into account increasing complexity, more staff, change in the business. So what are the auditor's concerns versus what the client's concerns are? We are interested in controls relating specifically to financial reporting. Anything related to accounting information are the controls we're interested in. Certainly management will have controls around occupational health and safety, health and well-being. Are you taking enough leave? We're not really interested in those as the auditors. We're just interested in the financial reporting controls. So how does information technology affect internal controls? And is anybody watching this show, Mr. Robot? If you're not, I'll give you some homework. Well, there's a couple of pieces of homework for this week. But if you're not, I would highly recommend watching the first season of Mr. Robot. It's a show about the importance of information technology and often the lack of controls. You'll be really wary about posting on Facebook or social media or using the internet. But information technology has improved controls a lot. It reduces the human error, all right? Because the robot doesn't get tired, it doesn't get sick, it doesn't get grumpy, it doesn't have a grudge against a coworker that they don't like, and so you go extra slow doing tasks for somebody. And so they're consistent. Whoops. They're consistent. They will do exactly what you tell them to do. But that may mean if your programming is not correct, then the computer is going to make the same mistake over and over and over again. And one small mistake, even if it's a 1 or a 2 or a 10-cent error, multiplied over 20 billion transactions at a company over a year, could result in something pretty significant. And I think it's the Commonwealth Bank has recently been caught out, and there's an article on my Facebook page, where their system programming for approving overdrafts was incorrect. And they had granted loans to a whole stack of people who shouldn't have been granted loans. And as a result, any of those people that the computer made the mistake on had their loans waived, essentially. And the Commonwealth Bank had to eat the cost or expense the cost of those particular loans. So there has to be a lot of control over who can access data and who can access programs. All right, so, if you're the bank manager of a store, you hope that that bank manager can't go in and change the software that's being used at the bank. But similarly, if you're a programmer at a company, the programmer should not be able to change the actual live production environment of a piece of software. So companies have a lot of confidential data. Right? We certainly know that the census had its issues in regards to security. Well, the data was secure, but people were attacking the website part of it. But if you're KFC, you want to keep secret the secret recipe of 11 herbs and spices, or the secret Big Mac sauce, or the Pepsi and Coca-Cola recipes, certainly. So data is really important, and then access to those programs as well. But so on the break, if you're looking for some procrastination, I highly recommend watching Mr. Robot. It will make you a bit more paranoid about using the internet, but a really good insight into the impact of IT. So what are the components of internal control? And these all come out of ASA 315. So ASA 315 is a really important standard. for that reason. Now I'm going to do this using a diagram. All right. So A is the control environment, and the control environment is really everything about an organization. Everything that you learnt in, do you guys still do managing people and organizations? Yeah? So everything you learnt in MPO about organizational culture and what it's like to work somewhere and philosophy, etc. So this is the feel, the base of the organization. What is their philosophy? B is the risk assessment process. What does the company do to minimize or evaluate threats to their organization? And in MPO, you might have looked at things like SWOT analysis, strengths, weaknesses, opportunities, threats. How frequently do they do it? How many people get involved? The next one is going to be our control activities. Oops. All right, and our control activities are really anything that we're doing to try and prevent or detect a material misstatement. All right. Then a company also needs to have information systems. Oops, let's do that in black. Over here. All right. Systems that collect data about what's happening in the environment. What is employee morale? How many sick leave days are there? Systems that collect information about risk. How much wastage have we got? How many orders are going unfilled? How many deliveries are late? How many accounts receivable are overdue? It also collects information about controls. Every time you go to an ATM and you take out money and you successfully put in your PIN and take money out, the system records that that control actually executed and occurred. And then the last one is monitoring. And that means that I'm monitoring the process of my control activities. All right? And importantly, I want to know when the control works, but key to that is that I want to know when a control stops working. Okay? Because if I'm chief of ATMs at a bank, I don't really want an email every time someone successfully uses an ATM, because that would just drive me insane. That would be millions of emails a day. Instead, I want notifications when ATMs stop working, when the amount of cash coming out of the ATM doesn't match the amount of cash that people are trying to withdraw, or when people try and put their PIN in too many times and then it chews your card. So I want to be notified when controls stop working, because when they stop working, that is when a misstatement is more likely. All right? So that's when a control breaks down, that's a time where fraud or error could occur. So imagine the UTS library. What do you need to get into the UTS library? Your student ID. You need to swipe it and it opens. But imagine if that was broken and you could swipe your Opal card or your credit card and it would just, or your Woolworths rewards card, and it would let you in. Then we know that there's a greater risk that more incorrect things could happen in that situation. So this is just going through, again, those same parts. The keys there, oops, let me do that in green. Philosophy and operating style. What's the structure? Is it very flat, like Google, with not a lot of layers of responsibility? Or is it something like UTS, where there's about me and 20 different layers of responsibility between me and the CEO? And even things like, who do we hire? How do we know that we're hiring the right people with the right skill sets? What do we do to train them? Risk assessment, which we've already talked about. How often do they do it? Who's involved? What do they do? Is it a basic SWOT analysis? Are they using statistics? Do they use external consultants? Now, frequency and the how often question will often depend on the industry. So if you're in something IT related or pharmaceuticals related, you're going to be doing risk assessment a lot more frequently than if you're in the business of making baked beans or Weet-Bix, because up until recently where there's now blends of Weet-Bix, Weet-Bix was the same for about 25 years. And not much really happened within that industry. So knowing your industry will also affect how frequently they need to think about risk. And some companies are really on the forward foot in terms of their philosophy. They're looking for, what are our competitors doing? What could we be exposed to? And other companies are more reactive rather than being proactive. And that has that's a big reflection on management philosophy as well. Now, control activities. Now, remember, these are my policies, procedures, and systems to make sure that everybody is doing the right thing. And that could be employees as well as customers. So things could include having proper authorization of transactions, who can approve a transaction, having good documents and records, physical control, checking that things are being done. But one of the key ones is something that we call separation of duties. Different people doing different jobs. So if I want to order something at UTS, I have to put in a purchase request. My manager, if it's below a certain amount, will approve it. It goes to a purchasing department of the university. They go and order the item. It gets delivered to the main receiving dock of the university in Building 1. And then they check it off that it's what was ordered, and eventually it gets delivered to me, and somebody in accounting does the recording. That is to prevent me from buying myself a Segway so that I can zoom around campus a lot faster than walking. It prevents me from buying myself a Bentley to drive to and from university in, not that I could afford parking. So it's to prevent people from making decisions that perhaps aren't in the best interests of the organisation. So the people who request items, there has to be authorization. The people who have access to the physical goods cannot do any of the accounting, so that there can be no cover-ups of information. So separation of duties, so the people who need to do different jobs, so the people who have access to assets, different from the people who do accounting, different from the people who can authorize transactions, different from the people who do record keeping. And that is the same for physical jobs like accounts receivable and sales, as much as systems jobs like IT as well. So in terms of authorization, you might have general policies for the organisation to follow, like JB Hi-Fi, salespeople can't give a discount more than 5%. But then you might have some specific rules. Oh, this TV is on special, we need to move these TVs. So as a salesperson, you could give a discount on this line of TVs up to 25% if you're trying to get rid of them. We need to also make sure we have adequate records. That could include things like pre-numbering documents. That's why everybody has a unique student ID, so we don't get anybody mixed up. We want documents to be prepared at the time of transaction so that we don't forget. And designed in a way to encourage correct participation. So most of our systems are almost idiot-proof. You can't enroll in a subject that doesn't match your degree. You can't do a subject that you haven't done the prerequisites for. You can't do more than X number of subjects in a semester. There's even things set up in the system where you can't do two subjects that are too similar to each other. So even when you're on eBay or you're using your internet banking, you can't withdraw money from an account that is empty, all right? Or you cannot order a quantity more than is in stock at the store. So it's about designing either forms or systems in a way that prevents mistakes, and that's really critical. We could also have physical precautions like locks on storerooms. Right? I can't even get to the button that turns on that computer over there. It's locked down so tight. If you've got important documents, they might be kept in fireproof safes. Now, of course, most of our accounting data is backed up to the cloud. But many, 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 many years ago, when I first started auditing 20 years ago, so that sounds like a long time when I say it like that, companies used to back up information to CDs every day or DVDs. And then once a week, they would send those DVDs to a secure off-site storage facility. Now all of that's in the cloud, but each day they would put it in a fireproof safe so that in case the building burnt down, the safe would still be there with the accounting data in it. So there could be controls related to IT programs, physical access, who can access what. So for example, in UTS Online, you can see the subjects you're enrolled in, but you can only view documents. I have the power to edit documents, enroll students, unenroll students. I even have the power on anonymous discussion boards to de-anonymize people. So that if you've ever posted a really ranty type of quote on a UTS Online discussion board, the coordinator can actually request to find out who you are. The same in student feedback surveys. So I can't see anybody's details in the student feedback surveys, but if you made a threat against me, somebody senior up at the university has access to de-anonymize it so that they know who that person is. And you know, they even edit out swear words. So it just says, word removed, word removed. But sometimes I think sometimes students are actually swearing in a good way rather than in a bad way. And then the other one that's critical, backup and recovery procedures. So what happens when an airline has a computer crash? Everything goes wrong. People can't check in, people can't buy tickets, they can't get planes off the ground. So having backup and IT recovery is really, really critical. This happened to British Airways recently. It also happened to Delta in the United States, where they ended up cancelling, I think it was like a third to half of their flights because they just couldn't get the computer systems up and running to connect, to print passenger manifests, to issue boarding passes. You know, they were back to people writing all of these documents. So physical control is really important. Having independence performance checks, so if you have a bank reconciliation, somebody's checking. Now, one of the other things to think about in terms of controls, I'm going to add a slide here, all right, is that you need to think about what is the risk that the company is facing, and that may be something like the risk of theft, and then what control should we see, okay? So I'll give you an example. My dad used to run a cafe in the old KPMG building down on Clarence Street, and he served a lot of customers coffee in the mornings. But what's the worst thing about lining up for coffee at somewhere that's really good? You line up to pay, you order, they write your name on the little cup, and then you have to stand there and wait, and wait, and wait. And some mornings it can be quite a long time. So my dad devised a different system, and there were 3 different coffee machines at his establishment, 3 different baristas. You would go up to the barista of your choice, place your order, and then they would make the coffee. But instead of paying a cashier, there was a big bench in front of you, and there were coins on it. And all the coffee was in $1 or 50-cent increments, $3, $3.50, $4. And you would put your own money down and take your own change. And he said, you know, my baristas can take coffee orders and process, you know, keep all the orders in their mind and make those coffees quicker than somebody who's writing on a cup, and the cashier process would slow everything down. So he estimated that he sold up to 30 to 40% more coffee than his competitors in the morning because of this system. And I said, well, Dad, what about the risk of theft? Right? Because I could easily, you know, order a coffee that's $4 and put $2 down instead. Or I could take too much change. And he said, well, I've got really loyal customers. All right? This was a coffee shop within KPMG. So most of the customers were ethical accountants, live by a strong ethical code. And if somebody came in and looked a bit confused, they would explain, oh, look, you just go to a barista, order your coffee, put your money down, take your own change. And I thought, well, that still, you know, relies on a lot of people's honesty. And he said, I have another important part of what we now would call his control environment. And besides KPMG in that office building, there was also the New South Wales Chief of Detectives for the New South Wales Police. So, all day coming in and out of the coffee shop were senior police executives in their uniforms, plainclothes detectives, and junior officers in their uniforms all day. So even people who might think about stealing would look around, oh God, there's police officers standing there, police officers standing there. So they're more likely to be honest. So he said that that was a unique factor of the environment in which his shop operated that encouraged customers to be more honest. And he said, look, even then, if people steal a few dollars, I'd rather sell 40% more coffee and then lose 1% of the cash that might be involved for those extra sales. So he accepted some shrinkage. And the police officers would keep an eye on everybody. They would say, excuse me, you ordered a large flat white. That was $4 and you only put down $2. And then as soon as somebody got, called out for doing the wrong thing, everybody else would be extra vigilant. Oh, have I given the right money? So while that might not work everywhere, that worked in his particular business because of the unique control environment. So you need to think about what is the business, what are the risks, and then what control should be in place. Now this is something that you can do every single minute of every single day, which I'm sure you probably don't want to do. But if you want to immerse yourself in auditing, every time you get on public transport, you go to buy something from a store, you're lining up at the movies or a nightclub, right? Nightclubs and cash entry is probably one of the highest risk and lacking in any sort of internal controls to count how many people get in. Who gets a receipt when you pay entry into a club? Nobody, right? Nobody ever gives a receipt. There's often no cash register. There's just somebody there with a box of money giving change, etc. You get your stamp, but in those instances, when you're at a club, you'd be like, oh, high control risk. How would I substantively test this? How would I gather evidence that revenue at somewhere like the IV or somewhere else is accurate? Unless they've, does anyone take credit cards? Can you pay door entry credit cards? They have a little clicker, but who's to know that that clicker is accurate? They could go click, click, click when it's only one person. All right. So we always have to look at the business, and I want you guys from now until the end of term. So every time you go out to a pub, you go to a restaurant that says cash only, I'm like, oh, risk of theft, manipulating revenue, okay? There's a reason in the United States that in a lot of businesses they say, if you don't receive a receipt for your purchase, please contact the store manager because that might be a customer selling you a good and pocketing the cash. So how do companies have information systems? They have their documents that go into systems that go into eventual information for us to look at, and then monitoring. And remember, I said before that I really want to know when controls are not working. Whoops. Because when controls are not working is when there's going to be an issue of misstatements. All right, so how do we obtain and understand internal controls? And here, where it says obtain an understanding, the thing that we're going to do as an auditor is we're going to do lots of interviews and make inquiries. This is why communication skills is the #1 skill that accounting firms rate that you need to have. Because you need to be able to go up to somebody you don't know, you meet for the first time, and get them to tell you about what they do for their job. And they're not going to want to do it. All right? Has anybody here worked in a business when the auditors have come to visit? And you hate it. People hate, oh God, the auditors are here. I'm going to have to stop doing my everyday jobs and help them learn about all this stuff. I'm going to fall behind. People get grumpy at the auditors. So they don't want to tell you very much. But you have to be able to communicate with them. And I sort of say that, this is a bit like corporate espionage. We're not stealing secrets, but you need to be able to build a rapport with someone that you don't know very quickly. So good communication skills is really important, making eye contact, being friendly. Nobody likes a grumpy auditor, right? So being friendly. But it's even things like the power of observation. So when I would go to meet a client, I would always say, whether that's an accounts receivable clerk or a manufacturing manager, I would say, look, don't come to me in the boardroom. Let me come to you in your office. And I would do that so that I could observe that person in their working environment. How do subordinates react to them? How do they deal with other people? What sort of personal touches can I see in that person's cubicle? Oh my God, you have a picture of dogs. I love dogs. What sort of breed is your dog? Oh, I've got a Japanese Spitz, blah, blah, blah. You bond over some particular facet, and that means that they're much more likely to be relaxed and open with you. Now, of course, if they're engaged in fraud, they're not going to say, oh, yeah, I've been doing fraudulent transactions. They're not that stupid. Hopefully. Well, we want to catch those ones, but when it's very rare. So you need to be perceptive, and you need to be observant. If an accounts receivable clerk on $30,000 or $40,000 a year is wearing extremely expensive shoes and suits and drives a really expensive car, you'd be like, well, is everything going okay in accounts receivable? Could they be receiving kickbacks from some sort of collusion scheme to defraud the company in some way? So we're always on the lookout for things that look unusual. And I know nothing about football. So when it comes to sports, I love baseball and I love golf. And those are really the only two that I know anything about. But I would go to some industries that would be extremely male-dominated, and the biggest thing everyone would be talking about on Monday is footy tipping. Footy tipping results, who do you think is going to make the final, blah, blah, blah. And so for those clients, I would learn about the sorts of football that they were interested in so that I could strike up that discussion. Oh, hey, how did so-and-so play? Did you see that call by the referee? That was such a whatever, whatever. And then you can broach another topic with them. Oh, by the way, could you get me this piece of information? Or what happens here in this particular situation? So it's about being able to approach somebody. And that's really, really critical as an auditor. So you need to understand them, assess the control risk, and then, if control risk is low or medium, test the internal controls. Okay? But and I'm going to adjust this slide here. When we obtain our understanding by going to interviews, having inquiries, and observing people, oops, I can't spell, an observation, I'm gathering information on the design of the internal controls. What is the company supposed to do? And then when I test the internal controls, I am testing, are the controls operating as they were designed? Because sometimes a company might say, oh, we do this, we have passwords, the password has to be changed, only this person can do the banking, so we've got separation of duties. And then I went to one client once and I said, well, what do you do when so-and-so goes on holidays? Who does the banking? And the junior payments clerk said, oh, it's fine because she writes her password on a Post-it note and leaves it on the side of her computer so that someone else can log in. So while the control might be designed really well, it might not be operating exactly as it's supposed to. So people might take shortcuts, systems might be broken, management might say one thing is supposed to happen, but junior staff go, I'm not going to do that, and they do something else. So we need to look at what could be the potential misstatements based on weaknesses or gaps in the internal controls. All right? Because if I know where a gap in the internal control system is, I know where a weakness is, I can pinpoint my misstatements. So if this is my set of transactions, and I know that there's a big issue right here, a weakness, and that this is an entry point for errors into the financial statements, then I am better off looking here, because that's where I know the entry point is, than everywhere else. All right? So identifying weaknesses in internal controls is critical to the auditor because it can help us make our audit much more efficient. All right? It'll allow us to pinpoint misstatements faster. So just like we might be here and suddenly the lights go out and the blinds go down and we hear a scream and then suddenly somebody ends up dead on the floor. Right. And I say, lock the doors, nobody's getting out, it was one of us, it had to have been one of us. And, maybe we have a student, is anybody doing a forensic science double major, double degree? No, not this year, okay. So sometimes they have forensic science students, they might come down and investigate and they discover, the person who did the murder was a left-hander. How many left-handers do we have? Oh, okay, so it's just me. All right. Usually there's more than one left-hander so that, then we have a smaller segment to target, but obviously now you know it's me that was the killer. So, but you can use that information to narrow down the gap of where to find the error. Rather than look everywhere, you have a specific place to look. And that's going to make it easier, right? Rather than saying, the book is somewhere in the library, if you said, look, it's somewhere in the section 520, then it makes it a lot easier. We've talked about this, about talking to people, we've talked about looking at documentations, and then observing activities. Now, the only problem with observation is just like when your mum is saying clean your room and she's standing there watching you and she's waiting for you to fold clothes and throw rubbish away, you're going to do the right thing while she's watching. But then as soon as she's gone, you'll be like, that's it, I'm just going to shove it all under my bed or chuck it into my wardrobe and just jam the door shut. So observation works well as long as people are not, you're not sort of watching them too closely. But you also, one of the best things you could ever do is go on a tour of the organisation. Now sometimes in financial firms that's really boring because it's just people in cubicles. But if you're looking at a manufacturing firm, you might notice, look, what is all that stuff there that looks really old? This machinery, it looks like it's had some improvements since last year. That could give you some information about property, plant and equipment auditing that you might do. Or you might learn about, okay, I can see that you're making this stuff. What sort of overheads are going into overhead allocation? You're not including electricity from the plant? Well, that's something that definitely needs to be included. So the tour allows you to build this picture of the firm. So how do you document your understanding? The narrative is a story, and then. So if you've ever seen Dude, Where's My Car? And they go to order Chinese food and she says, you put your order in, and then. So the narrative is the story. What we're going to learn about is flowcharts. So I want you to watch the YouTube video on flowcharting, and then next week we're going to have some class exercises about that. And then there's the option of a questionnaire. Questionnaires only work where companies are fairly standard within an industry because you're asking questions based on an ideal setup of a company, but every company is different, so it doesn't always work. All right, so how do we tell whether a company has good internal control or not? So what we do is we make our initial assessment of control risk based on the design of the internal controls. All right, and so what I'm looking for is I'm saying for every single assertion, is there a control that goes with it? And does that control do a good job of preventing that misstatement? So is there a process to make sure that every sale is made to a real customer? Is there a process to make sure that every sale at Woolworths is done at the right price? We've got barcode scanning as a control. Okay, so if control risk is low or medium, then we're going to look at testing those controls, and if there are weaknesses, we're going to engage in some substantive testing. All right, because that's a gap where I know a misstatement could be, so I'm going to search for it. All right, so in terms of evaluating weaknesses, as I mentioned before, we want to identify, what are the controls? Are there any absences of controls for key assertions? All right, and sometimes companies might have 50 controls around occurrence and accuracy, but no controls around classification. So companies can be a little bit lopsided in their controls. And then if we find any issues, so if we find weaknesses, So that could be a gap where there is no control, or there is a control that's broken. I want to tell management about it, because that means that they need to fix their own internal processes so that for their own decision making, they know they have the most appropriate information. So I could talk to the audit committee. I'll usually tell management in a letter at the end of the audit, give them a full list of all the things that we've found. But if it's something critical, you probably want to tell them straight away. You can verbally tell them straight away. All right, so how do we design tests of controls? We use the same procedures that we've always used before. Vouching, tracing, inspecting documents, but we're looking for proof that the control is effective. Is there a signature? Is there a match of something? Is there some sort of code to use? So what sort of things do we do? Inquiries. The inquiries of personnel are going to help us understand all of the components that go into the pyramid. Then we're going to gather evidence by gathering documents, records, running our tests, and they could be observing or redoing some client procedures. Now I am going to talk about something called the rollover, all right? And the rollover is a process by which, if internal controls have not changed since the previous year, then you can get away with not testing them and relying on last year's test. All right, so if they're changed, you can rely on previous year's testing. Now, given the current climate and pace of change in business, that's virtually impossible. Companies are always tweaking their computer systems, they're changing functionality, they're adding functionality. So the rollover is something we're going to see less and less of because controls are changing a lot more rapidly now than they are in the past. Okay. All right, so now let's get on to sampling. And sampling is this idea that I cannot test all of the transactions, so I'm going to test some transactions, and then I'm going to use those to make a general opinion or judgment. All right. So I'm going to select a sample here, and I'm going to select a sample of 2 students, and I'm going to pick the 2 students in the front row on the far side over there. And I'm going to make some judgments based on my sample, you guys. So based on my sample, what sort of shoes are you guys wearing today? One person's wearing sneakers and some sort of like boat shoes. So based on my sample, 50% of people in auditing today should be wearing sneakers with no socks. Invisible socks. And 50% of people should be wearing boat shoes. Now, who else is wearing boat shoes? Just one person. All right? So I've made a judgment about and a conclusion about my sample, but it doesn't generate to my population. I could also conclude that 100% of students studying auditing are male. So you have 2 gentlemen sitting down the front. I'm looking around the room. That's definitely not true. Certainly lots of females in the class. And I know that's not true based on the statistics. About 55% of people enrolled in the accounting major are females and only 45% male. So there's more women enrolled in accounting than men. That 50% of people should be wearing a short sleeve shirt of some sort, and then 50% of people should be wearing a long sleeve nautical themed stripy shirt, which we know is not true because I see 2 people wearing stripy shirts. That's it, just 2, I think. And that 50% of people in auditing should be wearing glasses. We might be closer on that one, I think, on the 50% of people wearing glasses. And that 100% of students studying auditing would be Asian, because both our gentlemen in our sample down the front are Asian, which, looking around the class, I know is not true either. So there are risks in making generalizations based on a sample. And that means we have to choose our sample really, really carefully. And samples need to be something that we're going to call representative. So we're going to learn And there's some things that we've crossed out. Now, what I don't want you to do, what we're not doing, is we are not looking at calculating sample sizes. All right, so don't look at the appendix in the textbook for that. So that's the idea of representative sampling. I want my sample, when I make a generalization or a conclusion about my sample, I want to be able to be confident that I could make that generalization about everybody. So here comes an article from a newspaper, and it says more than, and this is ridiculous, more than 500,000 Australians are going green by teaming vegetables and cereal such as zucchini and oats in their breakfast bowl every day. How many people did they talk to get this figure that 500,000 Australians are adding vegetables into their cereal? Is anybody here putting vegetables in their cereal? No, this came out of news.com.au's lifestyle and health section. So nobody here is putting zucchini in their oats.
Maybe they're talking about breakfast bowls.
But they're talking about breakfast. And it says the research points a shift towards a savoury breakfast bowl or savoury cereal bowl. And then they say just over 500,000 Australians also use nut butters, and then almost 1 million add herbs and spices to cereal. That's not me. I'm not even a cereal person. So the question is, how do they come up with these statistics? And I actually went to do the research. The research came from a Galaxy research poll by the Australian Breakfast Cereal Manufacturers Forum. I didn't even know one existed. And they made general conclusions about 1 million Australians using herbs and spices and 500,000 Australians using vegetables in their cereal by surveying 1,328 Australians. And they say that they've used a representative sample. Now, obviously, based on your reactions to my descriptions of adding herbs and spices and vegetables into our cereal, nobody's doing that. So the question becomes, was their sample really representative? Did they think about a mix of religions, ages, wages, education levels, locations, working status, ethnic background, gender split, or did they pick people, I don't know, I sometimes think, who would be more likely? And when I think about my friends, and I think, okay, well, who is more likely to eat vegetables in their cereal and do a lot of this really strange sounding stuff? And to be honest, it's my crunchy mum friends who are, the no vaccination people, and they're the, you shouldn't use disposable nappies because they're bad for the environment, and the no shampoo people, and they tend to live in a certain area within Sydney that is very alternative. So I think, did Galaxy really choose a representative sample of these 1,382 Australians to make conclusions about 1 million people adding herbs and spices onto their breakfast? So we need to make sure that when we select our samples, we do a good job of it, because there are some risks. Obviously, there's risk with sampling that's not associated with sampling, which is human error. You have a really big Thursday night out, and then you come to audit on Friday, and you're hungover, and you do a bad job of auditing. All right, human error stuff. And there's also sampling risk. My sample is not representative, and therefore I come to the wrong conclusion. Like, 50% of people today should be wearing a stripy shirt with a slightly nautical theme, whereas we found that's only 2 out of probably about 100 students here. So the reality was it's 2% rather than 50%. So when I pick my samples, I need to make sure that if 80% of my sales are in 2 months of the year, when I select my sample of sales, 80% of my sales in my sample come from that same rough period. So what about statistical and non-statistical sampling? So statistical sampling uses probability theory. all right, and random number generators to generate a sample size. It uses a mathematical formula to generate a sample size and collect the sample, whereas non-statistical sampling uses human judgment. All right, and they're both equally valid. You can use statistical sampling and non-statistical sampling or non-statistical sampling in real life. Now, the practicalities is that most sampling actually ends up being non-statistical. And the reason being is that statistical sampling gives you excessively large sample sizes. Sometimes it will say something like collect 5,000 sales journal entries to go and vouch. Now, it's going to take you weeks to get some junior or intern auditor or vacation auditor to go out and collect all 5,000 of those journal entries and then find the matching shipping documents and then find the matching invoices and the matching customer orders and then check them. So what we need to think about is what we call non-statistical sampling. So this statistical sampling usually involves random selection. So we use a random number generator to randomly select items. But you can also have situations where I want to search based on my judgment. So if I'm trying to find bad debts, then I don't want to search everywhere in accounts receivable. I just want to look at the ones that are most likely to be overdue. That makes sense. That's more efficient as well. So sometimes we're going to use random and sometimes we want to use our judgment. So in selecting representative samples, the most common method used in practice is the haphazard sample selection. So that's you in a box and then you attempting to randomly select 20 or 30 or 50. Under non-statistical sampling, average sample sizes are somewhere between 25 and 50 on most audits for most firms. We might want to select a block of transactions. So if every transaction is meant to, start from this order book and then be traced through, I might select 1 month's worth of transactions and check all of them were processed correctly. Or I talked about judgmental selection. So if I wanted to find obsolete inventory, then what I would do is I would calculate inventory turnover and then sort it by slowest to fastest moving. And then the slowest moving items are the ones that I would search for as ones that could be potentially obsolete. That's not going to work though if you're looking at Aston Martin or Ferraris because, turnover of 2 is like woohoo. But if you're looking at Hyundai or some other high volume manufacturer, then you're expecting to have higher turnover in those industries. Now, in terms of probabilistic or statistical sample selection, we have random with the random number generator, systematic, which is where we're looking for every nth transaction, so that could be every 100th, every 50th transaction. We could use PPS, which is selecting, more likely to select larger items, so larger items more likely, all right. And then it's sort of in a separate section on its own, is stratification. And stratification is dividing one population of transactions into groups. All right. Now, if this was accounts receivable balances, I might want to know the people who are 0 to 30 days, 31 to 60 days, and 60 plus. All right. Now, this has This has its benefits. Which of these segments would be most likely to have bad debts that need to be written off? 60 plus. Things that might need to go into the provision for doubtful debts could be in the 31 to 60 days. And then these, I would just check to make sure that they're being recorded correctly. And again, stratification, the purpose of stratification is efficiency. All right. Okay, so in terms of sampling methods, most commonly used is haphazard. All right, for testing across the entire year, could be haphazard or it could be random. All right, For testing completeness or cutoff, if you're doing cutoff testing, you only want to test around the end of the financial year, then you only might want to have a block. Or if you want to treat different groups differently, would be to stratify or break them down into smaller groups. You don't have to stratify if you don't think that you need to. Oh, I better hurry up. All right. So what about testing for balance for transactions versus testing controls? When I'm doing substantive testing, I'm looking for dollar value errors. Whereas here, I'm looking for instances when the control is not working. All right? And if there are too many instances where the control is not working, I'm going to need to increase my control risk, decrease my detection risk, and then do more substantive testing. And we're going to do some actual examples of this later on in class. Whereas in substantive testing, I'm looking for actual dollar errors. All right? So control testing just allows me to know, this control is not working. So if I substantively test in that area, I can find out exactly the dollar error that is going to be a problem. So testing internal controls doesn't help me say there's a $150,000 error here or $250,000 error. Instead, it just gives me information that I can use for my substantive testing later on. So what do I do with my steps? I plan the sample. All right? So firstly, what is the population that I'm going to need to select from? If I'm vouching, I need to start with journal entries. If I'm tracing, I need to start with documents. If I'm trying to prove that inventory really exists, I'm going to need a list of inventory to start with. Then I need to figure out, I plan my sample population, how many, and we're not going to go into the calculation of how many, I will always tell you how many. Select the sample, execute the audit procedures, and then evaluate the results. And the key for you guys is going to be evaluating doing the audit procedures, which we're going to do in the coming weeks, and then evaluate the results of what's happening. All right, so in terms of selecting samples, there's these lists with heaps of things, but I'm just going to highlight the key things. What assertion am I testing if I'm doing a substantive test? All right, what's the population? Is it sales transactions, purchase transactions? What is the unit I'm looking for? Am I looking for individual transactions? Am I looking for customers based on accounts receivable? The tolerable deviation rate, which is basically the materiality. What am I willing to accept for this account? And then we go into selecting the sample, executing the audit, and then making our conclusions in terms of the evaluation. And the same is similar for the test of balance. So here's an example. $250,000 worth of misstatements in a sample worth $2 million and the value of the population. So to calculate that, we use a formula that says we take our, wrong color pen. We take our misstatements, we divide that by the sample value, and then we times it by the population. Okay? So 250,000 divided by 2 million. Whoops. 1, 2, I've forgotten how many zeros. And then multiply that by 5.5 million. Okay. All right, so if I use my calculator and I do that, that gives me $687,500. And so the question then is this a material item? And how do we figure out whether that information, whether I would know whether my $687,500 is material or not? And that means I need to know the materiality or the tolerable misstatement for this particular account. So if I'd said materiality was 500,000, then compared to that, it's certainly less. Our error is greater. The 687,000 is greater than our 500,000. So in that instance, we would say, okay, definitely material. All right, and then later on, we would ask management about making an adjustment. all right? But what if materiality was a different number? So let's say materiality was 750,000. Then we have an issue that is not material. And we would leave that within the financial statements itself. So now let's look at a slightly more complicated example. So here I have one with stratification, and we're auditing accounts receivable. And so what I've done is I've taken the entire pool of accounts receivable and I've broken it down into some different days of being overdue. So 0 to 30, 31 to 60, and 61 plus. I've got my errors, my value of my sample, and my value of my population. So what I need to do is use my same formula on each of these little boxes of information. So let's do that right now. So 2,000 divided by 100,000 multiplied by 850,000 is 17,000. All right, let me just write that in. 17,000. Okay, my next one, I've got 4,500 divided by 85,000 times 450,000 means I've got errors of, I'm going to round up to the nearest dollar here, 23,824. I've rounded up to the nearest dollar. And then in my last one, $3,000 here divided by 100,000. Oh, and what you'll notice in number 3, the value of the sample is the same as the value of the population. So I've tested the entire population. So my misstatement is going to be 3,000. All right, so if I add all those up, 3,000 plus 23,824 plus 17,000 is 43,824. Okay, so if we are going to stratify, you'll notice here that I've looked at the value of the sample is different as a percentage. So in the first one, I looked at, hang on, let me check. I calculated, or I looked at about 12%. So I checked about 12% of the population. In my second strata, I checked 19%. All right, so I thought there was maybe more risk of misstatement there, so I've checked a higher proportion. And then here, you'll notice that I've actually checked 100% there because I'm more worried about the level of risk. Okay, so the last thing we're going to look at is something called monetary unit sampling, which says instead of using one transaction as the unit, what if I used $1? Okay, so generally you might have a transaction that's $500, a transaction that's $2,500, a transaction that's $10,000. And when we're normally sampling, each of these is one unit and has an equal chance of being selected. But here, under monetary unit sampling, we say that this is 500 units worth, 2,500 units worth, and 10,000 units worth. All right, so my population becomes the total dollar value rather than the total number of transactions. And the thing with monetary unit sampling is it has a tendency to pick up, like the PPS method, much larger transactions in them. Oh, which is what I've said just here. Whoops. All right. Now, when is it appropriate to test the entire population? Because sometimes it's not really sampling, but in some high-risk accounts, like intangible assets, you might want to look at everything. You might not want to select a sample of 1 or 2 out of 10. You might want to look at everything in high-risk accounts. Things where there are small numbers of transactions. If a company only has 5 transactions for something a year, don't worry about testing internal controls and then assessing the control risk, and then doing substantive testing. Just substantively test those 5 transactions. And then some things might be qualitatively material, especially something like executive remuneration. Something like that is really important to shareholders. They want to know that shareholders, that management are not being paid too much, they're meeting their KPIs, KPIs are being assessed appropriately. So even though it might not be big in terms of dollar value, it might be qualitatively important. All right, that's it for this week, everybody. I want you to make sure that you watch the videos that are going to be in your folder this week, and we will continue next week. Thank you. All right, so I'm just going to add a slide here for my key takeaway points. Because certainly we covered a lot. I'll change the color of that. Let's make that red. I want to cover the key takeaway points of things that I want my students to be able to do and understand this week. So the first thing is I want you to understand the internal control structure. All right. So what are the 5 components of the internal control structure or framework? Okay. The second thing I want you to be able to do is to be able to identify an internal control. All right, and you can do that by looking at different scenarios of wherever you are. Third thing, I want you to be able to read a flowchart. And there's a YouTube clip on that. So just read, not draw at this stage. Try to identify weaknesses in internal controls. So that might be a gap. That's really looking for a gap. All right. And then I also want you to understand the basics of implementing sampling, which is the various sampling methods and how to evaluate misstatements that you find. All right, which is the formula stuff. So these are the key takeaways I want you to be able to do out of this week to take into next week for our quiz. So have a great week. There'll be some extra YouTube clips on UTS Online for you to help you out with flowcharting. There's also some good summaries on sampling as well. So have a good week, everybody.